Ladies and gentlemen, welcome to the KDI School World Bank monthly webinar series. My name is Yeonji Kim, and I'll be serving as your MC for today's webinar. Before we get started, please note that today's webinar will be recorded for knowledge sharing purposes. This webinar is our joint venture with the World Bank, where experts from the bank will share their recent findings with the school community. We hope you gain exclusive insights into the cutting-edge research by the bank and have time to reflect on possible applications. If you have any questions or comments, please wait for the Q&A session or leave your messages in the chat. Now, I'm pleased to introduce today's distinguished speaker, Mr. David O'Sullivan. I'd like to take a moment to briefly introduce him. David O'Sullivan is a senior economist in the Fiscal Policy Unit at the World Bank with responsibility for international tax. David, who has been working at the World Bank since 2022, has 18 years tax policy experience in both direct and indirect taxes, including at the OECD, the EU Commission, and in Ireland at both the Finance Ministry as head of international tax at the Tax Administration as head of tax transparency. In his current role at the World Bank, he is leading the international tax program to support countries implement reforms agreed over the last decade, including on the global minimum tax, anti-tax avoidance measures, tax transparency, tax treaty policy, and VAT digital. David holds a Master's of Business Studies from University College Dublin and a Master's of Economic Science in Policy Analysis from National University of Ireland. Everyone, please join me in welcoming Mr. O'Sullivan. Mr. O'Sullivan, please share your slides when you're ready to begin.
Thank you so much. Okay, can everybody see the slides?
Yes, we can see your slides.
Brilliant. Thank you so much. And I think over the next 40 minutes or so, I'll try to bring you through a journey in respect to reforms to the international tax framework over recent years, and then with a little bit of a deep dive into the global minimum tax, which is one of those key game changers in the international tax system. And it's very good to be presenting to you this evening. It's 9 p.m. In the DC, I think a little bit earlier where you are. So I'm at the end of my day, but you're at the start of yours. So I'll move on in terms of a little background. As I said, Young V said at the end there'd be an opportunity to have some questions, and I would really welcome them and keep this engaging. So please note them, put them in the chat, and very happy to discuss what is a really, really important issue at the moment. So in terms of the international tax agenda, so the global corporate income tax system today, it actually has its origins in the League of Nations 100 years ago. And the initial focus in respect to international tax cooperation was to avoid double taxation. And this was on the basis that double taxation can impede the growth of business and investment. And the international tax framework for many years has been underpinned by a series of bilateral double tax agreements between countries. But we started to see that there was unfair competitive practices emerging, where we had base erosion and profit shifting practices. And indeed, it goes back to the late 1990s, where there was an OECD report on harmful tax competition, an emerging global issue. So it has been highlighted as an issue for many years, as MNEs have sought to find loopholes in international tax law, the different rules between different countries, having expensive advisors in order to enable to avoid paying taxes or minimizing their tax liabilities by shifting it to low and no tax jurisdictions. And typically it was artificial shifting of profits. So in terms of this emerging global issue, they highlighted back in May 1998 that while globalization has had positive effects on the development of tax systems and has encouraged countries to engage in base broadening and rate reducing forms, it has also created an environment in which tax havens thrive and in which governments may be induced to adopt harmful preferential tax regimes to attract mobile activities. And these harmful tax practices can distort trade and investment patterns, they can erode national tax bases, and they can shift part of the tax burden onto less mobile tax bases. So if it's less mobile, it may be facing higher tax rates. And this had this differential of treatment, which was, I think, undermining the fairness of tax structure. So this report looked at how the guidelines on harmful tax regimes, and it set up what was the Forum on Harmful Tax Practices. Now, did much happen in that period between the late 90s and the early 2000s? Not a lot in terms of there wasn't really that political will. Countries at the political level, they weren't really that interested. But a lot of this changed with the global financial crisis in 2008. While there had been the technical work, there was a lot of things, these are the solutions need to happen. You didn't have that political impetus. But when countries were becoming under serious pressure and serious financial pressure, when they were entering into recession, when they had to turn to taxpayers and domestic taxpayers and seek more tax revenues, where they're increasing consumption taxes, there was that focus, well, corporates cannot get away with this. Corporates must pay their fair share in the right place. And in 2009, the G20 kickstarted a greater focus on the addressing tax savings, including individuals in respect to both bank secrecy, but also businesses and the transactions of businesses. And the recognition that this work would need to be accelerated, and the OECD countries accelerating, but also key actors such as the European Union and as I mentioned already, the G20 countries. In 2013, the BEPS project, which is the Base Erosion and Profit Shifting Project, which is actually anti-BEPS, it was agreed with OECD members and associate countries. And in 2015, the BEPS actions were agreed, but this was it was a major milestone in terms of tax cooperation, addressing what were the leakages within the international tax system, but it was focusing on those harmful tax practices. And indeed, then we saw in 2017, and significantly, the United States under the first Trump administration, they enacted the first minimum tax, which is called GILTI, which was in respect to the global profits of US M&Es. Here I outline really what were the BEPS actions. I'm not going to go through them in detail, but there's certain aspects there in terms of minimum standards, which every country who's a signatory or wants to join the inclusive framework, and the inclusive framework is now 140 countries beyond OECD members who undertake to implement those minimum standards on countering harmful tax practices, to prevent treaty abuse, to re-examine transfer pricing documentation, which is the country-by-country reports, and also recognizing the need to have dispute resolution between countries, and to have where a country says, I'm exercising taxing rights, that you could have a dispute resolution process in order for avoiding double non-taxation. There are other reinforcement there of different standards in terms of artificial avoidance of PE status, aligning transfer pricing outcomes with value creation and so forth, the common practices and best practices, common approaches and best practices, which is hybrid mismatch arrangements, strengthening the controlled foreign company rules, limit interest deductibility, and have mandatory disclosure rules in terms of cross-border rulings that could have implications for other countries. And then there was other reports in relation to Action 1, the digital economy, data analysis, and having a multilateral instrument. And the multilateral instrument was to fast-track changes within treaties and being able to do that rather than having to renegotiate 100 treaties, a country could have an MLI, and that would automatically mean that the treaty changes would come into effect. The action one was actually the most contentious aspect of the BEPS framework. And why was it the most contentious? Well, it was dealing with the structural changes in the global economy, but also digitalization, and how could the tax system adjust to these new digital models. It did not achieve, in terms of corporate taxes, any progress. The can was kicked down the road and said, we need to come back to this. And countries said they needed to come back to this in terms of the structural changes. So what happened in terms of the next stage? So BEPS has agreed the known challenges, but then we had the two-pillar solution, including the global minimum tax. And that was agreed in October 2021, where almost 140 countries agreed this, where it included the global minimum tax, which is part of Pillar 2, and then a partial reallocation of taxing rights to the market jurisdiction, which is Pillar 1. And that partial reallocation was intended to get those top 100 companies in the world, that a certain proportion of their profits will be reallocated to the country where those digital services are consumed. So if you think about companies such as Google, in terms of Apple, the big countries where they consume, that those profits would be reallocated to the country of consumption. I should also say that it was the US Biden administration that actually brought the drive to this particular process, where they came in, they were very, very committed to an agreement, working through the G7, the G20 processes, the OECD. This was a number one priority of that administration to get this global tax deal. The GMT is significant, as it is intended to put a floor on tax competition with a 15% minimum effective rate for M&Es with global revenues in excess of 750 million. And this has a series of rules to achieve that minimum: the domestic top-up tax, where countries can exercise an option to ensure that constituent entities in scope pay the minimum of 15%. So an example here is, if you have a country, and we'll go into this a little bit more in detail later, but on the minimum tax, if you have a 10% effective tax rate, that effective tax rate in your country in respect to the constituent entity of M&Es, you can choose to apply a minimum tax of 15%. If you don't choose to apply it, then the income inclusion rule comes in, and say a country who has implemented income inclusion rule at the headquarters level, in this case, say a French M&E based in Paris, they will collect the additional 5%. So this is the country can choose to implement a minimum tax, get that within their own country. If they don't do it, then it's applied. And then there was an under-tax profits rule, and this is the backstop rule, which was to address non-implementation by countries, in which case, if an M&E located in a country that did not implement the minimum tax, there was still a mechanism to actually tax those low tax profits. And there's a mechanism there based in terms of how many employees that are in the M&E in a country, and also what the physical assets are. So there's a mechanism to do that. But it's also important that while the GMT has a floor on tax competition, it does not eliminate tax competition. There is a substance-based income exclusion, which is a technical rule which favors businesses that have substance in a country in terms of capital and employees. And there's also special rules for refundable and transferable tax credits. And I can go into that in a little bit more detail further in the presentation. In terms of the broad state of play on implementation of the international standards, so the tax transparency standards, and these are really, really important. They've been implemented in many countries. Over 170 countries have undertook to implement these international standards. These include exchange of information on request. So this is where a country can say, okay, there's an M&E operating in my country. I need to get information in respect to that M&E in terms of their structures and so forth. Okay, I want to do a request to the jurisdiction where that M&E is located, saying I require X and Y information. This is the foreseeable relevance. It can also be the case that there's an individual in the country, an individual of interest, and they say, well, I think this person has a bank account in X country. We've seen information of this. I want to get the information on that bank account because that bank account might show that they're actually not declaring taxes in my country and rather they're sending it and holding it in another country. So they can get access through that cooperation between tax administrations. We also have automatic exchange of information, and this is where countries sign up to standards where they push the information in relation to financial accounts held by foreign account holders to the country where those people are resident or domiciled. And in that case, the Swiss authorities will be sending the details of the bank accounts held by whatever to whatever country that the people are in, and the tax authorities have visibility on that and can see whether there are assets being held overseas that they should in fact be subject to tax. This is evolving. So, for instance, as technology is evolving, particularly in relation to crypto assets, from 2027, there's going to be a crypto assets reporting framework that countries will be actually sharing information in relation, which is the so-called CARF. So, it does develop. BEPS implementation has been very strong in the developed countries. So, for instance, in many G20 countries, definitely in the G7, within the European Union, it's been implemented and countries are benefiting from that. In terms of developing countries, there are still steps that developing countries can take to strengthen their tax systems, to implement those BEPS measures, to have transfer pricing systems involved that are up to international standards. And a lot of the work that we do in the bank and other developing partners do is to work with countries to strengthen their legislative framework. But it is having an impact, and we are seeing that. Currently, the OECD is carrying out a review of 10 years of BEPS, and there will be a report to the G20 this year. And from what we can see from the results, in some respects, they're very encouraging. In other respects, they identify that there's more to do. The implementation of the global minimum tax is proceeding. 50 plus countries have already implemented. And the expectation is that 90% of in-scope M&Es will be covered by it in some form by 2025, this year and next year. The subject to tax rule, which is a treaty rule, is part of Pillar 2, and this is a valuable option for countries. Pillar 1, the discussions are still ongoing. This is contentious. And this is contentious because the nature of the rules mean that the one country who has the most M&Es, if they do not decide to ratify this, it doesn't come into effect. That one country is the United States, and this is part of the convention. That's the agreed rules. Everyone has agreed. But in fact, the convention has not yet, it's been prepared. It has not yet been signed, and the next stage is ratification. So there is a sense of a process. The process has indicated, and the United States is focusing first in relation to global minimum tax, where they're trying to get coexistence between the US their global minimum tax system and the rest of the world global minimum tax, I should say the US minimum tax system. And that minimum tax, they have a domestic minimum tax, and they also have the so-called the GILTI, and the GILTI, which is the excess profits that are not taxed in the country of the subsidiaries of US multinationals. So in that case, if there's only 10% paid, they have to pay a top up. But what's interesting and an important difference between the US GILTI regime and the global minimum tax regime is the US GILTI regime is on the basis of blending of tax rates. So if there's a 30% tax rate paid in Germany, they can blend that with a 5% tax rate paid somewhere else. And if it's above the US GILTI rate, which is currently 12.5 effective, moving to 16 supposedly this year, but that's still up in the air, then there may not be top-up tax paid. The difference between the global minimum tax is it's calculated on a jurisdiction by jurisdiction basis. So if one country has only 5% tax, they will either have to top up 10% in their own country through a domestic top-up tax or somewhere else. There is no global blending, although they can blend on a jurisdictional basis. So on a jurisdictional basis, they may have 5 entities within a special economic zone, 20 entities within the normal economy, and if it's above the 15% effective tax rate, then there isn't any top-up tax. And that's important with some countries because they might have a 25% rate, a 10% rate, a 5% rate within the country, and there can be an element of blending of that. So other developments in respect to the UN Tax Convention. So over several years, there has been motions at the UN. There was an ad hoc group created in terms of what the tax convention will look like. The discussions are starting this year. So there has been organizational meetings. There will be a convention. There's agreement. There will be 2 early protocols to that convention, which is cross-border services and dispute prevention resolution. And there's meetings this year scheduled for August and November. There's also meetings scheduled for next year and into 2027, where they hope to get to a point that they have an agreed convention that will move to signing and ratification. The voting mechanism for this has been really, really contentious. At the OECD and the inclusive framework, the objective always is achieving consensus. At the UN Tax Convention, the voting actually for the convention will be on a simple majority basis, and then for the protocols on the basis of 60% of countries are in favor. Where this will be challenging in the future is countries can try to achieve consensus, even though there would be a majority vote, because that's within the terms of reference. But if a country doesn't agree with it, they can decide not to ratify, and this could lead to circumstances where there's double taxation. There won't be non-taxation, but there could be double taxation. An aspect of these rules, particularly around the cross-border services, are contentious. There is an aspect that the capital exporting countries are not really necessarily in favor of these big changes, but the capital importing countries have been seeking these changes and a process at the UN. It's a bit more sensitive. It has been presented as the global north versus the global south, but it's not quite as simple as that, because always in taxation, the devil is in the detail. And even within different continents, within Africa and within Asia, you have different countries who have different weight and different pressure, and they'll always try to look after their own interest. The OECD inclusive framework, it still enjoys wide support of countries, and the work is proceeding. And as I mentioned, the US is trying to seek to align the global minimum tax with the existing US minimum tax regime. Also relevant that in a tax bill going through US Congress at the moment, still not agreed, but they're seeking to get more punitive measures to target countries who might be targeting additional taxes on US multinationals. So that's something to watch this space. It's quite contentious. There's a nice article over the last few days by the US Tax Foundation that is warning against this and is highlighting that this could be something that could be not good for either the US or for other countries. So I think that's something which is be interesting to watch, as I said. The G20, international taxation, it still remains a priority item, and the underlying theme of the discussions at the G20 for the last 3 presidencies is to ensure that developing countries can benefit from the implementation of these standards, but also recognizing there's a separate process at the UN. But also the focus is shifting to domestic resource mobilization more generally, and domestic resource mobilization, there was a report by the IMF last year that said in terms of trying to increase tax to GDP, the international taxation measures might deliver about 0.3, 0.5% of GDP. addressing tax expenditures is about 3% of GDP, a factor of 10. Reform of tax administrations and institutions can deliver 2 to 3% of GDP. And there is low-hanging fruit in terms of domestic tax policies countries can take to increase that. So there is a disproportionate focus on international tax, but international tax has always been seen in this realm of trying to bring in inward investment and competing against countries in respect to investment. So moving now to a little bit more details around global minimum tax itself and some of the rules that are there. It is a 15%, it is a minimum tax rate. The rationale is that it ensures that large M&E groups above 750 million euros annual revenues, that they pay a minimum level of tax of profits allocated to the jurisdiction where they are, to each jurisdiction where they are present. It reduces the incentive to shift profits to low or no taxed jurisdictions. So, for instance, there have been several academic studies looking into what is the potential impact of this, including by the OECD, but also Oxford University, Charles University in the Czech Republic, and others are looking at this. Well, what do they think the impact will be? And they believe that BEPS behavior can reduce by 50%. And the reason, a lot of the reason for this is businesses should not be able to chase zero. And if it's at 15% a minimum, and would they have expensive avoidance schemes when they may only be reducing from an 18 or 19% effective rate to 15% rate? It's not expected that they will. Although countries who have very, very high statutory rates may still face that challenge in terms of artificial shifting of profits. It is a multilateral solution, and the importance of multilateralism is important for business and global business, and avoiding uncoordinated rules, complexity, and overtaxation. But what you will hear from many in business is that the global minimum tax is extremely complicated. There are high compliance costs in respect to it. So businesses is having voices about that. But at the same time, businesses, the large practitioners, they're in the process already of implementing this in many countries. And just to highlight that Korea, Japan, and other countries within the region, Thailand, for instance, have been early movers in terms of implementation. Singapore is implementing as well. There's a set of interrelated rules to ensure the minimum level of tax. And I mentioned these, the income inclusion rule and the UTPR. So we hear these, the qualified domestic minimum top-up tax, the income inclusion rule, which applies in the parent jurisdiction under a top-down approach, and the UTPR, which is the backstop rule. I should point out that the UTPR is very sensitive with the United States, and it's one of those red lines that they've indicated in terms of digital services tax and the undertaxed profits rule. The reason they don't like the undertaxed profits rule is because they conceivably say that we in the United States could grant a tax incentive, and they have non-refundable tax incentives that could lead under the global minimum tax rules to less than 15%. And that's something that Congress would say, we have decided to do this. And then another country reaches over, France, Germany, and says, okay, well, we're taking that additional 2%. And they will say, well, this M&E in terms of the subsidiary paid more than 15% in your country, and yet you're coming in and taxing our multinationals. I'm not saying that's my rationale, but that's the rationale coming from the United States government, and also pointing to the digital services taxes. So it is an element that it is contentious. At the OECD, there is a review process, there is a qualifying process in terms of countries as they implement, and they need to ensure that they're in line with the global minimum tax rules, the OECD global rules, to ensure that they actually are qualified and they get that qualification process. And there will be a process of peer review. I think the first stage in that is a self-assessment based on the legislation. The next stage will be more about the operation, and is it really a 15% effective tax rate in a given country? So that process will run for several years. So here's an example in terms of how it works. So if OPCO 1 is taxed less than 15%, then the headquarters country can impose a top-up tax and tax the difference. However, the source country can tax this first, either by introducing a qualified domestic top-up tax or reforming their tax incentives corporate tax regime to ensure that the 15% is achieved. So they have options. They can say all those tax incentives in our system that are delivering 5% or 0%, let's just reform them and ensure that the 15% is reached. If we're not going to reform them in the short term, let's implement a domestic top-up tax. And many countries are looking at implementing a domestic top-up tax as an insurance policy to ensure that top-up tax isn't taxed elsewhere. And to give a real example of this, if I was in a country that is giving a tax incentive that's delivering 5%, and you don't have a domestic top-up tax, that tax then will be collected by the other country. And that's actually a transfer. And in many cases, developing countries, is a transfer of cash from the taxpayers of a developing country to the taxpayers of a developed country. And this is the importance of the domestic top-up tax and a lot of the advice that the bank is giving to countries. So here is an example. The slides will be shared with you, but it shows in relation to the rule ordering in relation to the QDMTT, then looking at the income inclusion rule in terms of the blue is who can where it's taxed. There's also IIR rules where an intermediate parent entity. So it's an anti-avoidance rule to make sure someone can't avoid this. So there can be an intermediate parent entity is the one where it's taxed, or in relation to the UTPR. And that's the one, as I said, is quite complicated and very sensitive at the moment. The GMT is a fundamental change to the international tax framework. There are both direct and indirect benefits, revenue gains for countries, certainty and stability, and to reduce the incentive for artificial profit shifting. It's going to have a profound influence on direct policy in developing countries, particularly developing countries who've been using certain types of incentives, including tax holidays, to attract investment. Many countries will need to make reforms, whether to protect the tax base, to implement the GMT rules, or to carry out a deeper reform process, including tax and investment policy. So we in the bank are working with countries to help them shape their tax and investment policies to see, well, what are the options now and what are the options in the future? And for instance, last year or earlier this year, I was meeting with a minister, and they were talking about the implications of this and having new incentives. And they said, when I asked, well, what are your corporate tax rates that you offer? And they said, we have a 2% rate, a 5% rate, a 10% rate, a 15% rate, a 25% rate, a 32% rate. They're the different rates that are applying. And said, maybe the first thing, rather than new incentive, is that you look and say, I'm going to have one rate and that one rate, and to consolidate the rates. And I can also simplify things for business as well. So these are the kind of options countries can have. But it's also important that countries, that they take this into their own hands, they do the analysis that's needed and take the decisions that's right for them. And they will have options depend on their own circumstances and to have those policy choices to reflect those policy choices. So just really look at some of the GMT implementation. What are the options? And it is a common approach. There are different options for countries. It will depend on the country circumstances and these policy choices. And we've identified these in a publication that the bank produced in 2022, the status quo to do nothing. You can then take measures to protect your tax base. That's a domestic top-up tax, or you may be able to do quick fixes to your tax incentive regime. So some countries have had refundable tax credits. The rule says they have to be refundable within 4 years. Some countries had rules that were 6 years. They've changed them now to 4 years. So that's a quick fix that can be done to it. Then implementing the core global minimum tax rules, which is the income inclusion rule. The income inclusion rule really comes in where a country has headquarters of multinationals that were in scope. If they don't have headquarters of multinationals, it's not really relevant for them. And for many developing countries, it's not relevant. But there can be, they'll know from the tax returns, do they have those within their country? And we've done work with countries to identify, well, is the IIR relevant according to this base? Do they have the greater than 750 million? And in one country did a work, they thought they had, maybe one, and they had five or six, and it made it relevant for them to then consider an income inclusion rule as well as the qualified domestic top-up tax. And then we point to the level three reforms, which is broader CIT reform, that I mentioned. Do you look at rate reform, and how can you think about your tax incentive offering relevant to the GMT rules? These options do nothing. Common approach means that countries are not required to do anything, but you do have a risk of foregoing revenues to other countries, and it becomes more pertinent as more countries implement the global minimum tax. The measures to protect the tax base, prevent losing revenues to other countries, introduce a domestic top-up tax, evaluate and reform the existing tax incentives, and maybe consider a domestic top-up tax as a backstop rule. As I mentioned, the core GMT rules around the income inclusion rule will depend on the circumstances of a country, and the UTP or the under tax profits rule, which is the backstop. And then we really are pointing as a bank to say, look at the level three, look at the big picture, look at your corporate tax rate policy, look at the rates that you might be charging your domestic businesses versus your foreign businesses, look at your incentives. This is an opportunity to reform. So here I won't go through everything, but just to indicate that we kind of give these as a kind of decision matrix, a suggested decision matrix for countries, and what are the key drivers in terms of, well, what should you do, and to indicate what would be strongly recommended versus recommended, to maybe you need to look and have a wait and see. It has been a very significant development. Many countries, as I said, the do nothing option is not viable, but it is always an option, and countries should look to see, well, how many M&Es are in scope? What are the ETRs? Do I need to do something immediately? I may not need to do something immediately because I have a 20% tax rate, because I may only have a small number of M&Es within scope, but in time it will make sense to implement that. The domestic top-up tax, that's a really, really important aspect in relation to this in terms of protecting the tax base, particularly those countries who have many tax incentives. It has that opportunity to reform the CIT, and we're working with countries in relation to implementation. I've gone through a lot of this before, but it illustrates that 90% in scope, non-inclusive framework members. So this is the question that comes up. There's a 440 odd countries who are in the inclusive framework, but what if you're not? There is still opportunities to implement this, and there will be a process at the OECD to have that peer review. So you can say, I'm not a member, I don't have to do this, but you can implement and protect your tax base and get qualifying status. This shows those countries who've implemented. As I said, it's about 55 jurisdictions, and we see there East Asia and Pacific, Australia, Hong Kong, Indonesia, Japan, Malaysia, New Zealand, Singapore, South Korea, Thailand, Vietnam. Countries are implementing, and we're working with countries who are considering implementation in the region, and decisions will be taken in time. Many countries are evaluating this at the moment. What do I have to do? How important is it? How urgent is it? I'm going to go now, and if I have 4 minutes to run through the impact on the tax incentives. So what's happening with the tax incentives, and this slide gives examples, what types of tax incentives are impacted by the GMT, tax holiday arrangement, zero corporate taxes. They're not going to really be working in this new world, may be impacted where they have a reduced tax and reduced rate incentives, but this will come in terms of jurisdictional blending. Maybe it's okay in terms of blending. Certain incentives are compliant with the global minimum tax, others are not compliant. What do you do about tax holidays that were granted? So one country we've been speaking to, they have a tax holiday arrangement for 75 years. What about that? What will happen with that? And it's linked to a public-private partnership. These are the questions that many, many countries are having in relation to implementation, and it will have profound impact on how they offer tax incentive arrangements. Typically, the GLOBE rules, the GMT rules, have less impact on expenditure-based tax incentives, but they will have much more impact on the income profit-based tax incentives. These are the exemptions, the tax holiday schemes, and so forth. And the questions that countries will need to consider is, how does the country view the global minimum tax? Are there any in-scope entities located in the countries? Are the incentives in place impacted by the GMT? And what are the issues in terms of the inputs, in terms of substance within the country, what can have? And this is all leading into, well, what is my new policy on tax incentives? And also bearing in mind that you will have businesses who are in scope of the GMT and businesses who are out of scope. So on that basis, I took one additional minute and now open for any questions you have. Just to say that what I went through there in 40 minutes, typically when we're doing an intervention with a country on this, it's over a period of 5 days, and we go really, really deep into these issues and do calculations with countries. So thank you very much for your attention.